Welcome back to Two Gents, Two Cents, brought to you by 15 Minutes of Finance. This is episode 18, How to Incorporate Tax Planning in Your Retirement Strategy. James, we've seen some things recently where it seems kind of an umbrella value add without a lot of substance defined, I'll say, where advisors propose we incorporate tax sheltering within your investment strategy. And there's no real explanation of what that looks like. What does that mean to you? What do you think when you see an advisor kind of offer that? What does that mean to you that they actually do? What does that mean?
Well, first, the first thing that comes to mind, like initially, is just like what we see in media and YouTube and honestly anything online where it's like this catchy headline, right? This like just as bait clicky as possible.
And for the people who speak English out there, I think clickbaity is the
whatever.
The
it's clickbait, bait clicky, whatever. It's all trying to get you to click. Okay, click the link. Click. That's what I think of when I think of these ads, or like I saw one the other day from, well, I probably can't say their name, but from blank blank, and blank blank was like, annuities are evil. We will save you from the evil that is annuities, which I think is true. I love that.
It kind of sounds like one of our episodes.
Yeah. No, I kind of like it, but I already know exactly, like, their whole thing is mutual funds. So they're going to take these people in these annuities and then put them into these mutual funds. And the way they do the mutual funds is they get a 5% up front. It's a whole different financial planning strategy that they use. But it's basically like, that's not necessarily true that they can take you out of annuities. Sometimes you can't leave an annuity at all. You have to just go from annuity to annuity. So that's what I think whenever I hear people say, oh, learn how to maximize your IRA, maximize tax withdrawals to your IRA. There's nothing really special, right? Like there are some things you can do, but it's not for everybody. And what I think that they use those clickbaity ads, titles, little videos, excerpts, what I think they use those for is just to get in front of you to info gather, so they can find another way, something else about you that maybe they can sell you something. That's what I think. I
mean, there's a lot of intangibles that go into any service. Like, one thing I talk about all the time in the world of CPAs is the absurd overcharging of like entity formation fee. So if you're paying a CPA to start a business for you, for example, oftentimes CPAs will charge from $1,000 to $2,000, and they'll list out what they provide. We file your LLC with the state and all other relevant parties. We file your statement of information. We keep records on file for the 3-year audit requirement. The LLC form takes 5 minutes. The statement of information takes 2 minutes. And that's basically it. I mean, everything else is just factually they're keeping a copy of it for you. That's nothing. I talked to someone yesterday who I'm going to help them start their LLC. I charged $100 because all they literally needed was just an LLC. It's going to take me 20 minutes. That's probably still overcharging, but there has to be some sort of minimum in case something comes up and it takes more of my time.
So who pays a CPA to do that? Because I remember starting the LLC for 77, and it was just like, it took me 8 minutes. I felt like I was like, oh, this seemed pretty easy. Obviously, the overall management of a company, or a business, you want a CPA's help, but who's charging that?
Yeah, I mean, it's similar to a car dealer who's like, oh, you need this and this and this. Like, I think the accounting world posits it as, oh, you don't want to do it yourself in a risk audit. Like, well, if you do it wrong, they could come after you. And then are you confident that, so there's this kind of scare, similar to how annuities are sold. There's scare tactics. There's like an illusion of complexity, like, oh, you have to do your statement of information within 90 days. That has to be correct. It has to perfectly match the info on the LLC form. So they kind of sell this complexity that it's really not that bad, but it seems like, okay, I should just pay the $1,000 and get a professional to do it.
Get it done right. Yeah,
exactly.
Illusion of complexity. That's a good descriptive.
Illusion of complexity followed by the R in the circle. So that's mine. You can't use that without paying royalties.
It is trademark.
So all that to say, to this topic today, when people are proposing this, oh, we do a lot of, tax planning. It's a way to just add intangible, itemized things to justify an AUM fee. Like, we charge this much because we don't just do your investments. We work carefully to tax shelter your investment vehicles, and they just make it sound complex, which really just means they don't put you in things that earn ordinary income, which is almost no investments in a retirement account. Like, it's really not a hard thing, and really it's not a lot that they're doing for you. Like, when we work with our clients, 90% of my involvement is on the back end with James. So usually he's not sitting down with a client and saying, hey, here's how much we're going to save you in taxes. James and I have already talked in developing your portfolio about creating a portfolio that is creating tax advantaged income, and we'll break down actually what that means in terms of the value we can offer or other advisors can offer. And so a lot of that analysis has already been done by the time that you're talking to an advisor on our team. It's really not a lot that an advisor is doing for you themselves. It's probably a conversation with another person on the team that's kind of back end advising the advisor almost on the tax expertise side that for a lot of advisors is sort of the missing piece. It's the only thing that they're not necessarily an expert in.
And we'll probably eventually dive super deep into these different tax portfolio strategies or taxation savings, but just one on top of my head that I can think of is, so we've talked to you guys about TAMPS. It's a turnkey asset management program. That's just some advisor in Bora Bora managing your portfolio when you think it's your advisor in Solana Beach when it's not. Okay, or whatever your hometown is. It's somebody else elsewhere, nowhere near you, you're paying to manage your money. They'll have portfolios called tax strategist or efficient tax growth. And that'll get sold to somebody like, hey, let's put you in this. It's a little bit more expensive than our regular growth portfolio, but all that is just your portfolio might not even need any sort of tax effects. There might be zero need to have any sort of tax efficiency in your portfolio at this time, but they're going to sell it to you that way because everybody loves saving on taxes. It's just a buzzword in my very general description of how these things are sold.
Yeah, no, I think that's totally fair. So let's substantiate what we're saying with a very large kind of truth about things. And it's a reason we kind of justify saying oftentimes this is a buzzword. If you work with an advisor who manages investments for you, or a wealth manager, or a CFP, whoever, you are probably having them manage one of the following: a traditional or Roth IRA, a traditional or Roth 401k, 457, or some sort of pension plan. A lot of times you don't have an advisor managing a pension plan, it's through your provider. Here's the secret about all of the things I just said. There's no tax on any of those transactions in any of those accounts. That's the reason why often there's no such thing as tax strategy, because this is what a lot of people don't realize. You hear about investment vehicles. We talk to clients. We've talked about this in our annuities episode where we compared it to other fixed income investments like U.S. Treasuries. And we've said one of the benefits of U.S. Treasuries is that you don't pay state income taxes on that interest income. That's not true if it's in like a traditional 401k plan. If you're in a retirement plan, the only taxes you pay are ordinary income taxes on the withdrawal of money. And it's all money. It's interest, it's capital gains, it's appreciation on the initial investment, and it's the principal that you put in all along the way. Because remember, traditional 401k, traditional IRA, you got a tax deduction when you put the money in. So that's the benefit, tax deferral. If you're in a tax deferred plan, there isn't a tax benefit down the road. It's one or the other. You either get tax-free income in retirement or you get tax referral at the time of contribution. So any withdrawals from a traditional 401k, it doesn't matter where that money came from. it's going to be ordinary income in the year withdrawn. So you're only really benefiting from comprehensive tax analysis if you have things like real estate or individual brokerage accounts not in a retirement vehicle, and therefore any transactions have tax consequences. The sale of stock is going to have capital gain, short or long term. Treasuries, bonds, they're going to have interest income with different considerations. There's vehicles that have both. You might be in a mutual fund that might have capital gains when you sell. It also might have dividends or interest along the way. So that means that there's no tax consideration at all inside of any of those investment vehicles, which James probably has a better, idea of percentage of clients, but for most people, that is where the majority of their wealth is tied up, and it's in their 401k or, in rare cases, an IRA or a Roth IRA. But in the vast majority of cases, everyone's wealth is in real estate and their 401k plans.
Yeah, I mean, numbers-wise, less than 10% of our clients, even the high net worth ones, have brokerage accounts. It's very rare.
Yeah, because even people who have a lot of money, it's probably because they were earning a good job and they were maxing a 401k or some sort of, stock option plan that eventually rolled into their retirement plan, and they have their wealth that way. So very few people are just have $3 million in just a brokerage account, and they're just actively trading in an account that's not tax sheltered. So we're going to use an example now of a prospective client. We've just sent some concepts and some options to them. We're waiting to hear back, and it gives a good idea of what our planning process looks like. So if you do have money in just a brokerage account or in real estate where the sale of those things will create tax consequences, then you do want to talk to a professional. My tax plan episode 2 days ago talked all about real estate and the different ways to shelter tax on real estate sales. We're going to talk about taxation and tax planning inside of investment vehicles today. So here's the option that we provided a client. Their basic question to us was, here's the return we're getting on our real estate. Here's the value of that real estate.
It was bad, by the way.
It was not a great return given the value of their wealth. Very, very, very much lower than what they should be getting on that much money. And so they wanted some options of like, what can we do? And their big thing was, look, we don't want to pay capital gains on millions of dollars of real estate sales. And they had inherited it forever ago and had been depreciating it. So if you remember what we talked about in the real estate episode about depreciation, it decreases your cost basis. All that to say, they're basically going to be taxed on the full value of those sales when they make them. So we were kind of comparing, well, here's some options we could put the money, and is it worth it to eat that tax bill now in exchange for future growth and more options now of what you can do with that now that it's not all tied in commercial real estate. So here's an example of some tax planning that I did on the tax proposal side, and it gives you an idea of what actual tax planning inside of investment vehicles looks like. There were three, so their main goals were, we do want capital to grow. We also want it to be an easy transition period in case I pass before my wife. The husband was over 10 years older than
15. He was 15.
About 15 years older than the wife. So, that's a consideration that people in retirement have to make. And we want more return than we're currently getting, which was around 4 to 5%. Okay. So there's three options we gave that kind of met those goals, and then we gave our recommendation. So we talked about municipal bonds. They're on a decently high tax rate given their income. Municipal bonds, if bought by a municipality in the state that you reside in, you don't pay federal or state taxes. That's a big consideration. We talked about treasuries, which we've talked about many times on this podcast. Totally satisfies the no capital loss, element. They're guaranteed. They're not going to go down. Right now, they earn about 4% interest, and there's no state taxes, so that's a consideration. And then we talked about, well, what would it be just in terms of having it in a brokerage accounts and having your income be from the slow sale of stocks. We invest in a portfolio and mostly buy and holds, and we sell a little bit of it each year, and maybe there's some dividend stocks as well. Sort of fun fact about dividends. Qualified dividends, which means dividends from a domestic U.S. company, they generally get long-term capital gains tax rate. So they're taxed the same as if they were a capital gain from the sale of an asset like a stock or a house. So that's one benefit of dividend portfolios, where you can tax plan because if your income is from dividends rather than interest, you're paying the long-term capital gains tax rate, which is 0, 15, or 20%, rather than ordinary income tax rates, okay? So here's the kind of analysis that comes down to, and the assumption here, you need to know the tax bracket you're in. So if you're in the situation where you're trying to tax plan your investments, you need to know what your marginal tax brackets are. When I earn an extra dollar, what is that taxed at federally and by the state? California, we have a income tax, one of the higher income taxes. So state income tax planning is a big element for California clients, where if you're a Tennessee client, or I believe Florida, Texas, or a couple others, there's no state income tax. So that like treasury income benefit doesn't exist to you, right? Different tax plan for your situation. So here's the analysis that basically we make, okay? Municipal bonds in California that were kind of similar to their investment options in their area pay roughly 4% interest. Remember that they are in California, okay? So state income tax is a big consideration. They're in I believe it was a 24% federal income tax bracket marginally, and a 9.3% California marginal tax bracket. So the tax analysis here is we adjust for the taxes saved. So we take 4% interest, but then we add basically 33% because we're not paying 33.3% between federal and California taxes. That creates a post-tax return, an equalized return across the investments of 5.32%. Then we compare, well, here's where we get federal treasury rates. When we sent this proposal, they were at roughly 5% for 3-month treasuries. They do still pay 24% federal, but remember, there's not state income tax. So we adjust by 9.3%. We get a post-tax effective return of 5.47%. Then we look at dividend income in a dividend portfolio, maybe combined with some capital gains. They're both subject to capital gains taxes. So that's 20% in their bracket. So they would be in that 20% long-term capital gains tax rate bracket, which means the 5.8% kind of average dividend yield of a model portfolio we would make for them. They pay 4% less on federal taxes, okay? And so the equivalent yield is 6.55%, okay? So that's the analysis that we create in how tax planning can exist in a brokerage account where there isn't the tax deferred treatment of income within that account.
And then just real quick to add to that, these people have $8 to $10 million. Okay, this isn't somebody with $1 million, $2 million, $100,000. Like the ads that you're seeing, this tax efficiency, work with us, will maximize your tax efficiency. It doesn't really exist, generally speaking, for people who aren't high net worth. I don't mean to be mean to people. It just isn't really a factor. So when you hear that, I would keep that in mind. It really is for the wealthy. And if you're speaking to someone who used that method to get a hold of you, they're just trying to sell you something else.
Let me push back on that a little bit, actually. The idea that this is primarily for high net worth individuals, because you're going to save less in taxes if there's less money that we're working with. But at the same time, the tax you pay on gains is a significantly larger consideration for people with a lot less income. So a plan that saves them $2,000 in taxes might be significant for their budget, where someone with $500,000, we might save them $80,000 by structuring their portfolio in a way where they're earning tax-free income or long-term capital gains tax income rather than, ordinary income tax rates. But $80,000, they don't even feel. It's just more wealth. So I do think that tax planning, while less significant numerically, can be very significant in terms of budgeting for someone who is low income. And for someone who does have a little bit of money to work with, remember that the long-term capital gains tax rate is 0% for up to $94,000 in adjusted gross income. So if all of your income from, let's say you just receive $300,000 in cash from your mom, right? She passes away. you might develop $80,000 in yearly income from that portfolio. That would be high. But let's say you've got some other
very
income.
high, but
That'd be very high.
It's pretty good.
$500,000, $600,000, whatever it is, right? And so if you have no tax plan and you just like you put it in like a high yield savings account, you earn 5%, and you just pay ordinary income tax, you might have $80,000 to $90,000 in income and pay $8,000 in taxes. If you had that in a dividend portfolio earning only capital gains, you would pay 0% in taxes. So not only would that tax consideration be significant for you as a percentage of your income, we could be saving you 10% by at least taking a look if there's a better tax structure for what you're invested in.
How many people are getting $300,000 from their deceased mother?
I mean, that's a pretty common life insurance number. I think there's definitely a lot of people who inherit that $200,000 to $500,000 number when their parents pass. Right? That's a pretty normal number.
Yeah. Look, the title or the idea that of this like clickbaity. If you have XXY in your IRA, we can be tax efficient with you. It's almost always asset based. It's almost always a figure amount that you have to surpass to be able to work with them. So I would say they target people with money.
Oh, for sure.
Not that you can't have tax efficiency if you're not making money. I'm just saying that it tends to be the people that are in like that. They're not ultra high net worth, but they're not middle America. They tend to be the target, and it just ultimately, I don't think it provides value to them.
Yeah, I think that's totally fair. I mean, most advisors, let's be honest, are not going after people with $100,000, right? So whether or not that's significant to you, you're not being targeted by advertisements by financial advisors. Right, because they want people with at least $500,000 or at least $1 million or whatever their bright line is for their firm. And we work with some people just because they've been business owners I've worked with on the tax side, and we just have a relationship. And so we say, look, normally we have a minimum. We'll help you out for a low fee. You don't have a lot of money, and we've done that for a lot of our clients. That we do have a minimum for walking.
We say we have a minimum, but I don't know if we've ever enforced it yet. But yeah, Look, this stuff takes time and investment, and it's a lot, right? In our industry, it may sound kind of, they have a minimum, like they're hoity-toity, but I mean, realistically, most people don't need a financial advisor or portfolio management until they're like scared to lose their money is kind of what I would say. So if you've got $10,000 and you're scared to lose it, you should absolutely hire somebody. But we have people that we speak to that have $600,000 and they're like, I don't really feel like I need one yet. So that's why there's a minimum.
And there's right that they don't need one. Generally, people benefit from one and their returns would be higher. But like if you're 30 and you have $900,000, yeah, you could put it in the index. You'll have millions of dollars when you retire. You don't need an advisor. The question is, do you want to maximize? It's a question of efficiency and min-maxing, I guess, for all my video game people out there. It's like, yeah, you could beat the boss, with the sword, but it's technically not the best build on your character. There's ways to maximize your situation.
Dude, we got nerds listening to this, dude. I can't be dealing with any of that.
Nerds have money too, dude. There's a lot of engineers out there who have played a lot of RPG games and they need an advisor.
That reminds me of a story. So I was like, so what was it? 2020? It was the first gaming ETF came out. I think it was 2020. It might have been 2019. And I remember I'm talking to my dad and he's reading, I don't know, Yahoo Finance or whatever. And he's like, hey, what is this gaming ETF? People pay to watch other people play video games? And I'm like, yeah, like that's that's like $1 billion market. And he goes, what? And I go, yeah, don't you remember when I wanted to be a professional Halo player and you told me I should just get used to asking you how much butter you want on your popcorn because I'll be working at the movie theater? And of course he didn't say anything. But gamers make money. You're right. Anyways, that was a rant. All right.
All that to say, oftentimes the idea, if you're targeted with a retirement account and the one of the value adds to you is all of the tax strategies they employ, it's probably dishonest because there really aren't tax strategies you can apply within a tax-deferred retirement account. That's one thing we want to get clear. That's why we're saying that this is often bait click.
It's bait click.
It's
yes.
often bait click, and it's not honest because there really isn't tax strategy. If you withdraw the money, congrats, you pay taxes. If you don't withdraw the money, congrats, you don't pay taxes. You can keep it in there and keep growing it. So there really isn't a lot of considerations to make. If you have a lot of money and you are in the rare case of people who have significant funds in individual brokerage accounts or high yield savings accounts, you should talk to an advisor that has a tax expert on their team, because there is actual tax analysis. Or real estate. You want to talk to somebody about, how do I sell all this real estate and move it into the market? There are tax strategies for you. So there are absolutely tax planning elements to investment portfolio management. That being said, be careful falling for all of these bells and whistles that advisors use to sell their services, when often there really isn't a lot going on in that service. And really what you want to pay for is a good advisor that gets you good returns. And don't fall for all the bells and whistles.
Okay, he said it. He nailed it. Nail on the head, or head on the nail, whatever. Bait clicky, whatever.
Let's just reverse them all. Nail on the head.
Whatever.
Head on the nail.
There is not a lot going on behind the scenes for these fantastical packages or offerings that these financial services offer you. There's almost always, I would say 99% of the time, maybe treasuries are the one exception, but 99% of the time, anything that you're going to take, you're going to have to give something on the other end. Almost always. That's all I have to say about that.
So the last thing I'll add is the really only really big consideration to make is, should you stay in a deferred account in general? And so this is for people who generally are between 30 and 50, although it can be applicable to people closer to retirement. If you have significant money in a tax-deferred account, like a 401k, 457, traditional IRA, there is an initial very important tax discussion that should be had with a tax professional who can forecast projections for you to say, should I make a conversion transfer from a traditional to a Roth account? So there are conversion rules, and we won't get into the specifics of how to qualify and whatever, but just know that there is a potential choice you can make, especially when you're in that 30 to 45 range where you're between 20 and 35 years from retirement, and then you want to make a choice. Do I pay taxes on all this money now so that I can convert it to a Roth and then not pay taxes in retirement? That is a super important consideration, and anybody with hundreds of thousands of dollars or more, or even I would say $100,000 or more in something like a 401k who no longer works at that company, you should have a meeting with a tax professional and a financial advisor, or at least one of each, and get both opinions and make that decision of if you should right now in your life convert to a Roth account and have that managed and be more aggressive with it once it's under now the tax-free benefit of Roth treatment rather than the tax-deferred treatment of how it's been traditionally. So that is a super important tax consideration. We have those meetings with people. Those are always fun meetings of someone who's 38 and you just sit down. What are your goals? When do you want to retire? What's your risk tolerance? And then we make projections for them and make recommendations, and we help answer that question for them of, is it worth it to pay taxes in this account now and make that conversion? So that is available to people. It's important to know about, and it's important to consider. Again, if that's not you, if you're just talking about you're retired and how is your account managed, your traditional account, there's not a lot of tax considerations for you. Don't take money out that you don't want to pay taxes on. That's the position you're in. You're retired. You have a traditional account. That's where you're at.
And I'll finish it with this. Although everybody has their own flavor, right? Like I view investing like ice cream, like it's Baskin Robbins. There's 31 ways to do it. There is no lazier, more restful way to invest than the stock market. Every other investment, every single one, requires effort. Okay, it requires effort and attention. But if you just have money in the stock market, generally speaking, just the S&P 500, the market, the overall market, you have to do nothing. Okay, you have to do absolutely nothing. So that is something to consider when worrying about how you're going to invest your money. And although there are tax strategies for every, all 31 flavors, there is just nothing that requires the least amount of effort from you other than the stock market. And that's what I'll say.
Comment on the video what your favorite flavor of ice cream is. What's up, YouTube? Don't forget to like, comment, subscribe. Cool. As always, guys, thanks for listening. We appreciate all of you. Thanks for everybody who sends us topics they want to hear covered. Please feel free to comment, send us messages directly on a question you would like answered in an episode, and we'll answer that question pretty much in the next available episode. So we love answering questions from people. We hope you're learning a lot week to week. I would say we've been pretty good. We've been pretty consistent for about a month now. Three episodes a week. Baby. Monday you get the tax plan, Wednesday you get 2 Gens 2 Cents, and Friday you get the stock market 15 minutes of finance analysis. Whoop, whoop. So we love doing it, and hopefully you guys keep listening. Send us comments, and as always, invest early,
invest often.
See you next time.